All right, let's start with matters banking. Equity Bank Group has today released its Q3 report indicating that the bank has disbursed 214 billion shillings to customers in digital loans. According to the lender, the suppressed economy has seen the Kenyan subsidiary struggle compared to other regional subsidiaries, with the DRC subsidiary continuing to make great strides, even as the transaction balance to 50-50 between the local currency and the US dollar. And as Jimmy Mbogona reports, the bank has remained bullish that DRC will not experience any FX losses owing to their dollar deposits. Good afternoon, Jimmy.
Well, thank you very much, Noah, and a very good afternoon to you too. Yes, as you rightly said, this was the Q3 performance of Equity Bank Group, and we were just looking at how the bank has performed. And of course, just recently we have been having this conversation around the macro environment in the country. You will remember that not too long ago, we looked at the numbers, particularly by Safaricom's Fuliza, which was about, Safaricom was able to disburse about 419 billion to different customers. Now, guess what? Equity is fast catching on that number, because from what we have heard today is that they have been able to disburse about 214 billion to about 1 million unique customers through their digital lending platform. Now, I'm joined by Dr. James Mwangi. We just want to have a look at some of the impact of the macroeconomic environment and why Kenyans are consuming so much. Dr. Thank you so much for making time to speak to us after an intense 3 hours of conversation. Now, one of the things that we have been having a conversation around is the macro environment in the country, and this is also translating to the demand for capital from most Kenyans. So from what you're saying as Equity Bank, how is this trend going to pan out in the next 2 years, the next 3 years?
It is true we are going through very difficult macro environment, and Equity Bank this year has used its profit and loss account to shield its customers. We have registered yield on loans of only 12.1%, while we see government treasuries are up to 18. So it means our customers' risk pricing is lower than the sovereign risk rating. And we did this deliberately just to ensure the businesses survives, households survive, because they will be there tomorrow. And shock comes, and the shock has started breaking, as we are optimistic that interest rates have peaked, inflation has peaked, and so what we anticipate now is to start seeing, as inflation comes down, interest follows slowly, and the businesses then starts to survive. So we chose not to pass over the additional cost of borrowing because the reliability or the funding side repriced. Inflation affected our operating cost. We decided to absorb that, and as everybody will see from P&L, our interest expense grew much faster than the interest income because we didn't pass that cost to the customers. The same with the cost of operating the bank, grew much faster than interest income, but again, we didn't pass that cost. So we said, this time, let's choose the customers. Our profit will come later. We sacrifice the profit. However, God is good. Our subsidiaries in the region overperformed. And as a result, when we combined the group profit, we were up 5%, doing 36.2 billion shillings for the 9 months profit after tax. Now, going to Reading, we've realized that equity was built on disrupting and removing the barriers. And we've realized convenience to customers is everything. They want to have access to their money 24 hours. So we have digitized the bank. And I want to thank our customers for having been very patient with us when our systems were not holding. We have now stabilized the system, and what we are now building is the capability. We have overtaken all the fintechs and all the banks in digital lending, and we're cruising up to the leading digital lender. The preference we have seen for the customers is because we are using bank rates. So our rate of borrowing is maybe a fourth or a quarter of market rates, and that is what has created that great interest. We also have a very elaborate agency and pay with equity merchants that are helping to be digital channels, and we are excited because this provides convenience. What has really amazed us is that the average for all the other lenders per loan is less than 10,000. And for equity, the average loan of our digital loans is 45,000 shillings.
Yeah.
So we are really leading for the lead economy. We are leading for business needs, and we are leading for family needs.
All right, so Dr. Of course, there's the question of working capital lending and particularly going for volumes as opposed to going for margins. So there's one that might think this is a risky move.
We decided to take risk on Kenyans. Everything has a risk, but we have worked with Kenyans for the last 40 years of Equity's existence. Together with Kenyans, we overcame the challenges of COVID. So together with Kenyans, we'll overcome the challenge of macroeconomic challenges of inflation, exchange rates, and interest rates, and the depreciation of our Kenyan shilling.
All right, there has been a lot of volatility, particularly within the FX market. And when you look at your subsidiary in DRC, one of the things that we are seeing is the majority of your loans there are being issued in dollars. So as a bank, what are you doing to make sure that you mitigate against that FX risk?
DRC is a completely dollarized economy. Our deposits are in dollars, our loans in dollars. So there's nothing to hedge against. 99% of our loans are in dollars. 99% of our deposits are in dollars.
All right. So, Dr. again, there's a question of NPL and loan loss provision that we have seen. And of course, there has been some interesting moves in that space. So maybe you can help us understand the thinking behind that.
A heightened microeconomic challenge will always lead to some businesses that were not very well positioned defaulting. We'll see disposable income being taken away by inflation and depreciation of the currency. As a result, what you do is to try and support. And Equity has stepped up its effort to capacitate and de-risk such borrowers through financial training, the use of guarantees, risk-sharing guarantees, so that we cover those loans, but also aggressively provide provision. So 67.6% of all our NPLs are provided for.
All right. So, Dr. lastly, before I let you go, as we go into Q4, there is the question of what keeps you up at night. And also, when you look at some of your subsidiaries, which ones are you more bullish about going into Q4 and into the next year?
We're very excited that all our subsidiaries are now returning profits that are in excess of their cost of capital. And that means that we've built a sustainable model. As Kenyans mature, that it means that the DLCs and the others are behaving like startups. So we are in it for a long time, and we expect investors to continue to enjoy good. What keeps me awake is whether we'll accomplish our objective of really transforming lives in Africa and scaling our opportunities for wealth creation. So I invite our fellow Kenyans to jump into it, and we do this together.
All right, thank you so much, Dr. And of course, we'll be looking forward to the other segments of the business, particularly something that has, of course, that is notable to note is the area of insurance and also health. And we'll be giving you more details, particularly of how the bank's balance sheet currently is set up and just looking at those numbers and piecing them together so that they make sense for our viewers and potential investors. But for now, back to you.
Well, thank you very much, Jimmy. And talking about health